Hey everyone, in this video I sat down with fellow investor and YouTuber Michelle Markey to discuss all things investing. Michelle is making wonderful videos based on investing and personal finance topics, and she's a kindred spirit, a diehard fan of Warren Buffett and Charlie Munger. If you haven't subscribed to Michelle's channel already, I would highly recommend it. I have left a link to her YouTube channel in the video description below. In this video, we discuss a wide range of investing topics, such as our investing philosophies, our opinions on cloning, where we think the markets are right now, and much, much more. So without further ado, please enjoy this conversation with Michelle Markey.
Hey CJ, it's great talking with you today, and I'm so happy to bond with you over the fact that we're both mutual admirers of some favorite investors of ours, Charlie Munger and Monish Pabrai. And I'm so excited to learn from you and see what you think about investing right now in early 2020 and how you got to follow some of your favorite super investors and what your investing practice is like. And I'm happy to give you also feedback about what I like to do. And I'm just so excited to talk with you today. So thanks for talking with me.
Yeah, I really appreciate it, Michelle. I think this is going to be an interesting conversation. So, do you want to get started with maybe our philosophies for investing? I guess. Um,
Sure.
okay, I can go first. Well, basically, the philosophy comes from this might be the same for both of us, but the philosophy really comes from Charlie Munger and Warren Buffett. Uh, and it's seeking investments with a margin of safety, um, and coupling that with wonderful businesses, not just cheap businesses, but good businesses, hopefully at great prices, is what I'm looking for. The have your cake and eat it too type of situation. Those are very rare, so that necessarily means that there's not a lot of action in my portfolio, and it also means that there's high amounts of concentration in my portfolio. So those are kind of the main drivers of how I invest and
Same
how I have
here.
been. Yeah.
Yeah, and I agree. I'm curious to learn how you got to the point of studying Warren Buffett and Charlie Munger because I learned mostly about them through a couple of other investors that I really got into their podcast, Phil Town and Danielle Town, and they were super into all things Buffett and Munger. So they got me really into learning more about the whole world of, these sort of quote unquote value investors, even though in some ways, some of them are not quite traditional value investors like Ben Graham style, as I've come to learn. So there's actually a little bit of a difference between what a lot of people think of as value and also what maybe some of these investors maybe actually do. And I'm happy to clarify the difference. But yeah, like I came across their podcast some years ago, and that got me into that this whole world of trying to learn how to invest. And I felt just super relieved and excited that I could finally have a methodology of investing that I felt like made sense to me instead of, kind of reading analyst reports from various Wall Street banks. And I didn't know if I should believe them or, what all the stars meant on some of the rating agencies when you look at stocks or funds, like who knows where those stars are made of. And so it didn't really have any meaning to me to look at some of the traditional finance stuff that's on websites. And I kind of felt like finally I could know how to value a company by doing a margin of safety calculation and try to figure out the intrinsic value. And so, yeah, I'm wondering, how did you get to coming across Buffett and Munger?
Yeah. First, I'll say I wish I had come across Phil Town when I first started investing. He is somebody that I still don't. I mean, I kind of know his philosophy, but I haven't read his books, which is actually a real shame. But he seems like a really great investor. I love his YouTube channel, and he invests in a lot of the same companies that these guys like Warren and Charlie invest in. So uh, he's a good one to
Yeah,
follow. But
yeah, and the books are not too long of a read, so I'm sure you could get through them pretty quickly and briskly. And I don't know if you read his book with his daughter Danielle, but that was also a pretty good book with a lot of pretty straightforward formulas about how to calculate margin of safety and a few other valuation methods called payback time and also 10 cap. And I thought those were pretty straightforward and relatively easy. I mean, they might be a little bit foreign at first, so I have a little bit more knowledge, having studied Phil more closely, but I think a lot of people could benefit from reading the Invested book by both Danielle and Phil Town.
I have read that book, and I really like the 10 cap method. It seems like a nice sort of really straightforward way to try to get to the intrinsic value of a company quickly, which I love. So that is a good book, and I recommend that for anybody, beginners to experts. So
Yeah, agreed.
yeah. But as far as Warren and Charlie, I was fortunate that the first investing book, the first time I really thought about investing, um, was when I read Poor Charlie's Almanac. And the
Mm,
way I came to that book was my friend started his own hedge fund boldly, and I admired the freedom with which he operated. And I asked him pretty much straight up, what are you doing? What do you do? I didn't really have any idea. The whole area was pretty foreign to me. And he said, "Here, read this book, and if it doesn't change your life, then what I'm doing is probably not for you." So, but needless to say, Poor Charlie's Almanac definitely definitely changed
yeah,
something about me. So really
that's awesome.
resonated. Yeah.
Oh, that's great. Like, do you feel like you came upon, your friend and book, that style of investing, when you felt like you were ready to, kind of transform in your investing style?
I didn't have a style before it. So my
Okay.
style was try to earn money.
Oh yeah. Well,
Yeah.
I mean, that's a good point. Like I only say style because like I learned sort of how to invest when I was a teenager, but I didn't really, sort of a difference. Like even though I could know how to buy a stock in my brokerage account when I was like 17 or 18, like that didn't mean I know what I was doing. So when I came across like Phil and Buffett style, like all of that transformed how I was investing. And instead of just like, I had some family members who guided me when I was a teenager, and they said, oh yeah, like maybe some dividend stocks. But like I came to realize, like, at some point, what's the point of investing in some of these just stocks for their dividends when I didn't understand the company, and then also their stock prices happen to go nowhere for a while. So I realized like that's not a good way to invest. So like that helped me to transition actually from being like just in whatever stocks, maybe for dividends and maybe in index funds, to just being a concentrated, mostly only stocks only. Like I try to not be in mutual funds or index funds if I don't have to be.
Yeah. Yeah, definitely. Do you feel that your teenage education of investing helped or hindered you
Oh, I
as
think, yeah, it definitely helped. Sorry, didn't mean to cut you off.
oh no, I was just going to say as you began to actually take a look at different investing approaches.
Well, I mean, back then had no idea what I was doing. So I would say that like for a lot of years, from teenage years into mid 20s, I had no idea what I was doing. So it's only like a few years ago when I came across like Phil and Danielle that like it really changed from just sort of winging it, like kind of just being in some dividends and ETFs and index funds, to being like, oh no, if I want to actually have above average results, I need to like not be in these things that are uber diversified and that everybody else is in. And, if, stuff hits the fan, I don't want to be, cratering in my portfolio like everybody else is. So I would rather be in my own boat and not in the same boat as everybody else is, you know, like, when the tide goes out, everybody else is swimming naked, but I didn't want to be that. And I would rather, swim against the grain, but feel reassured in my process and methodology. And I'm able to be calm and like chill, even if my portfolio is like down 50%, like it doesn't phase me anymore like it did maybe when I was like a young person. Like I used to think like, oh, it's bad if my portfolio is down like 20%, but now, you know, I think like the lowest one of my stocks ever went was like down 60%. And I was like a little bit unnerved, but I didn't like freak out to sell my stock. So that's
Mhm.
how I'd known I'd like fully transformed into like a Buffett style investor.
That's good because the core concept for me that really transformed things is thinking about um, shares as an ownership of the actual underlying business. And that idea right there, if you actually take it to heart, is enough to help you weather the storm of any 60% drawdown. Um,
Oh
from
yeah.
from my experience, uh,
Yeah.
it was transformative. So
That's awesome. And so did your friend having introduced you to that book, did it make you also want to open a hedge fund someday? Or like, is that what you're kind of
I
hoping to go
uh,
for?
I've had some sort of back and forth with myself about this. I thought that that's what I might what I might want to do, but I'd rather just get financially independent and manage my own money right now. That's kind of where I am. Um, Managing other people's money and taking fees from that does, I mean, it's a possibility, but I don't know if that's exactly the life that I want. Because I love investing, but I love other things too. So um, that might make investing less fun for me,
Hmm.
if that makes any sense.
Yeah. Oh yeah, I could see that totally because I mean, the people who invest in your fund also have certain expectations, and there could always be people who want to bail when markets look choppy, and then then you're just when, like in this kind of strategy, just when you want to say load up the truck by buying companies on sale, you might have a lot of people leaving the fund, and that's counterproductive to the end means. And dealing with just investors in a fund, I can imagine, could be a little hectic.
Exactly. Um, you have to have the perfect share, not shareholders, but um, investees in your fund for it
Hmm.
to seem like it's going to work. Because if they're not fully on board with your strategy, then yeah, they can. If you have a lockup period, they can pull their money. They're screwed. You're kind of screwed. It's not that fun. Not to mention the stress that could potentially lead to.
Hmm.
Yeah. So
Right. And you're onto something with that because I think that's part of why Buffett ended his Buffett partnerships and then just transitioned to, I mean, even though it was sort of a mistake for him to buy Berkshire Hathaway, instead of running a fund by actually owning a company, he could decide how he wants to allocate capital, and he doesn't really have to answer to direct investees. And even though the people are shareholders in Berkshire, it's I think it's a little bit of a different scenario because they're not like necessarily redeeming money out of the fund. Like people could sell their shares, but then someone else will probably buy them, and you've already publicly listed. So like it's a different structure, and I think that probably benefited someone like Buffett way more than just continuing to run funds.
right, it sort of turned his capital structure almost permanent in a way. And plus, he
Yeah.
was able to take advantage of the float after buying insurance companies and stuff. So
Oh yeah,
yeah, that
for
was
sure.
yeah.
Like that's how he had some of the most leverage to be able to get the kinds of returns that he's gotten is through all of the insurance premiums.
Yeah, is that a common misconception that Buffett was never levered at all? I mean,
I mean, I think people maybe wonder about how he was able to do it. Maybe like I mean, I have to read the letters more. I'm sort of like midway through, and maybe have to go back to like see how he describes like, using the insurance float as like leverage. But I mean, like it's I don't know. I guess when people think of leverage, like I normally think of leverage like I'm borrowing money from a bank and that I owe interest on, and it's a similar concept in that the money that he's sort of borrowing from people who pay their car insurance or other premiums to insurance, he's sort of borrowing their money, but like he doesn't have to pay them any interest on it. He's only paying them if they get into an accident or whatever. So I don't know, I guess like even though I know it's like leverage, it doesn't feel the same way like normal leverage or margin that we commonly talk about.
right. Yeah, it's more consistent. It's more of a subscription based leverage where there's
Yeah,
money coming in
exactly.
every month, and sometimes you have to
Right.
pay a very high interest rate occasionally in spikes. But yeah,
Hmm.
it was the best mistake of his life.
Yeah, I mean, it worked out. I mean, and I feel like that would be awesome. Like if, I mean, not that insurance is a walk in a park, but if people can figure out business models where they get consistent cash flow from whatever business it is, whether it's people eating C's candies or insurance, then if you can take that money and reallocate it to produce more cash, I mean, that's the best of both worlds.
Hmm. Absolutely. And I think Monish Pabrai actually bought an insurance company, but he ended up selling it very shortly
Hmm.
after because he realized that the business was actually very difficult. So it's a credit to, because I think he wanted to do exactly what Buffett did, basically try to use that float to uh, reinvest.
Yeah.
But it's not a cakewalk, as you say. It's a very difficult business. That's and it's more of a you're operating a business, which is not outside of Pabrai's wheelhouse or Buffett's wheelhouse, but it's a lot of extra work compared to analyzing companies, which, needless to say, you can do with your feet up. But
Yeah, right. I mean, I can only imagine how brilliant, people like Ajit Jain, or I want to say Ed Simpson, I think, who just recently passed away. Um, like Ed Simpson, I think, ran a lot of the insurance operations for many years. I hope I'm saying that name right.
I think it's Lou Simpson,
Oh,
but
sorry, Lou
no,
Simpson.
it's like, yeah,
Yep, sorry, that's the one. Lou Simpson.
I think he allocated his own capital from Geico, if I remember correctly. I haven't really read, I have been planning on reading more about Lou Simpson, um, because obviously has had spectacular returns, but I am unsure of how he got there. So that would be an interesting
Yeah,
study.
yeah, for sure. Because I mean, especially in trying to understand the world of insurance more, I think. So yeah, but I mean, it just goes to show if it's even outside of the circle of competence of someone like Monish Pabrai, like it's better to know where the bounds are of your knowledge than to keep making a mistake if something happens that you don't expect.
Yeah, for sure. Speaking of circle of competence, it's a really tricky topic. Um, I always feel like I'm pushing the edges of my circle. I don't know. I'm not too experienced or anything. I would still say I'm very near the beginning of my investing journey. So it seems like every company I look at is an opportunity to expand my circle of competence. How do you feel about that? Do you reject ideas outright if it's quote unquote outside of your circle, or are you open to sort of prodding around trying to figure things out that you may not have necessarily seen before?
Well, some things I try to stay open-minded to, but others I sort of put in like a soft, too hard box pile.
Mm-hmm.
Like some things, if like for example, a lot of electric vehicles, like I still feel like that's outside of my circle of competence. So even though I, I've made the mistake of owning a car company in the past, but not that I lost money on that, but it felt like a mistake because maybe I didn't really know enough of what I was really owning. So that taught me a harsh lesson about, even though I thought I did my due diligence and I thought I understood cars enough, maybe it wasn't quite enough. And like I only regretted owning that company because I could have allocated that capital differently. Like so it's on like, it's I don't mean to sound like it was a bad thing. Like I still made money on it, but I would have expected myself to do better as an investor. But then I realized that even just owning that one car company, that even though everything seemed like it should happen a certain way for that company, like it didn't really appreciate in its value. And I, like the first chance I got to kind of like get rid of it, I like wanted to just be out of that because I realized it's too much for me to like try to be better at knowing what's going to happen in the car industry with everything that's being disrupted. And so I just, for now it's maybe in a like a soft too hard pile. I'm not saying no to cars or EVs forever, but the fact that like there's still more to learn, I think, is that like I would rather learn more about things that are much easier to understand, like Starbucks, than than something else. And I only say Starbucks because I used to work there as a teenager, so it was it's easier for me to know what goes on with Starbucks than to know what goes on with all the electric vehicle companies.
For sure. And in a way, it's not time wasted necessarily, but and you're going to learn more about the EV and automobile industry than, or by studying individual companies than you would any other means. But yeah, there are certain, those two actually fall into my soft to hard pile as well, because while I'm interested, I think the future is just way too hard to predict, uh, unless the company has really solid free cash flow right now, for instance.
Mhm.
uh, there's not much I can go on as far as valuing a company, for instance, like Tesla. I don't want to rag on Tesla. The product seems to be beloved and all that, but it's too hard. Yeah.
Yeah, and part of what I'm just thinking is that, like, you know, where we are with, like, where markets might be at right now, it's a little bit tricky because there's so much promise that a lot of growth and tech companies offer, and, like, who isn't a fan of a lot of the latest and greatest? Like, I think most of us as millennials, we're huge beneficiaries of all the advancements in tech, and, like, we have it way better than, like, a few generations ago, and it's amazing how much there's so much promise, and there continues to be so much promise. And I felt like I learned something really interesting from listening to a Guy Spear webinar, where he talked about how a lot of the old ways that he used to, value businesses and think about businesses are not as applicable. I don't know if you watched this talk that he gave with the Kolkata Investor Group.
Yeah, I think I did see that. Yeah.
Yeah, and he mentioned how, he's trying to expand his circle of competence basically around a lot of new tech that's really revolutionizing everything in front of our eyes, he said. And he said he was kind of like slower to, to embrace, like, trying to value tech a little bit. And it's so hard when some of these companies haven't been around for 5 or 10 years and they don't have cash flow, or maybe they don't have any real cash flow to show because they're always reinvesting it, like Amazon. So, like, how do you know how to value an Amazon? I haven't come across, like, necessarily the best measures to value companies that don't have, some of these traditional measures that Buffett or Phil Town would have used, like looking at free cash flow. So if you don't have free cash flows to judge a company by, what else could there be? And, like, what Guy Spear was sort of suggesting was, let's assume that if earnings are 100% the same as revenues, like he thinks it's a little bit expensive if a company is trading at basically 100 times earnings or 100 times revenues. Like, that's still too insane for him. So, knowing that, I mean, I don't know what is a more reasonable, benchmark. And I feel like maybe the more that we expand our understanding of tech and where future tech companies are going and how they report according to the GAAP rules, there might be new parameters to kind of figure out, because I think that everything is moving more and more toward tech, like Guy Spear has talked about. And if all companies are transitioning to being some component tech, um, we might need new tools to be able to value what is a good company to invest in based on, like, different measures, like, say, customer acquisition cost, or whatever, customer retention rates or whatever. So there could be different metrics than maybe, like, more historical value investing might not have always incorporated.
But I'm waiting for somebody to write the intelligent investor for tech companies. That's what I'm looking for, because that's one of the things that I've been actually trying to, get better at understanding. A lot of the main investors that I'm following right now, like Pat Dorsey and Rob Vinall and Josh Tarasoff and investors like that, they're value investors, but they seem to have quite a handle on the growth element, that for me is still kind of difficult without actually being able to see real cash flow. So yeah,
Yeah.
valuing something based on revenue is a difficult leap for me, but we're getting there, because I think there's quantitative factors that are really important that need to be beefed up as far as just value investors understanding it. But there's also qualitative factors. Understanding moats is more important than ever within tech. every tech company wants to claim that they have network effects and switching costs, but not every company is going to have those, to the degree that they preach and believe. And you can only take the word of projections so much. So that's where being a reader of the future is really going to come in handy. That's why world leadership,
Yeah,
I think, is going to be more important than ever, continually relevant.
right. Yeah, I mean, you're so right. And, like in retrospect, like I'd use things like Salesforce at work, like in the mid 2010s. And it was a decent type of application. And, that stock, I'd be like, it seems like it has a huge community and like the CEO is really popular. And like there seems to be so much going for Salesforce and maybe it has a moat, but like, according to a lot of metrics, it never seems like it's been on sale. So it's like, you know, how can you, where do you even begin to know if this would be like either A, like, within your circle of competence, and then B, like having like accounting metrics that you can process, and then C, how do you judge how big its moat really is and the impact that it truly has? Because you could easily have, like, not to hate on IBM, but you could easily, have IBM saying like, hey, we're doing cloud and, join us and, do all this stuff with us as IBM. But like the reality is their stock has kind of not really gone places. Like it's been a little bit of a laggard. So, you could have any company saying like, hey, we're doing this cool new advanced thing, but like some companies are more believable with what their cloud activities might be than others, I guess. So it's I don't know, it's sort of maybe knowing enough, or how, like, figuring out enough of who else believes what this company is saying is legit compared to, if they're kind of just trying to fake it until they make it.
Right. Yeah, and there's a big difference too between established companies like Salesforce, for instance, or the new kid on the block like Coinbase or something. Just less
Mhm.
operating history, even though there is clearly, some might say, evidence that the business is going to succeed long term. It's just much newer, and that's the place where I'm kind of looking is the more established tech zone, because of the very fact that there's more history. So there's got to be something in there that the investors are seeing. Um, for instance, an investor, Josh Tarasoff, his largest position is in Salesforce, and he bought it recently. Actually, I think you can buy it right now
Hmm.
for the same price that he paid. Um, and he's a genius. So,
Oh, wow.
but what's going on? He's not a genius. I don't know, but the return on equity for that business is hovering around 3%. So explain that to me. Why is it such a wonderful business? That's what I'm getting tripped up with on specifically Salesforce, for instance. But the examples are uh, everywhere in the tech sphere. So
Yeah, I mean, it, like, there has to be some other measure that these investors are going with instead of some of the obvious, like, ROE, ROIC, or free cash flow. Like, I don't know. Like, and it's hard to know um if like, sometimes we don't know what else is in some investors' portfolios, right? Like we don't know if it's acting as a hedge to something else for whatever time being. And who knows, like it may or may not, whatever we think, unless we really know that someone is just like tends to be a buy and hold long-term person, like Monish or Guy Spear. Like some other people could be doing different kinds of techniques, and sometimes it's hard to know what's really going on. But if like, I don't know much about that investor you just mentioned, but if he's a buy and hold long-term kind of person, then
yeah,
maybe that is, just something that that person plans to hold for the next 50 years.
yeah, that he comes recommended by Monish Pabrai most recently, but I've also heard Guy Spear recommend him as just an investor to learn from. I think he's one of the guys who's probably trying to teach Guy about how to value companies like this. I would have to imagine, because it's nice you can see the public. This is completely switching topics, but on Twitter, for instance, you can see these public interactions between these guys. Guy Spear interacting with Josh Tarasoff. There's a ton of brilliant minds on Twitter, so that's been just really fun to watch them kind of learn in public. Um,
Yeah,
Yeah.
that's
Right, that was a
true.
little tangent, but
Yeah, I mean, I think it's wonderful the more that some of these really good investors are sharing publicly that they're willing to, kind of pay it forward that way. I mean, they don't have to. They could all have their own secret meetings and, just be chatting to each other, but, it's kind of nice for the rest of us who are trying to still become, I'm speaking for myself, like I'm still trying to become a better investor. So I'm just grateful, whatever crumbs they're willing to leave behind and share with everybody else.
right. And there's a danger in it because sometimes I tend to hang on those morsels too heavily. Because an investor can say one thing and next minute change their minds, which
Like
is a good
Monish.
thing. Right. Yeah. And it's a good thing that they do that because if you realize, hey, I found a better opportunity, please make the switch. But that's where kind of understanding the business versus just completely copying somebody is a tricky line to toe, I think. What's your take
Oh yeah.
on cloning? Is that something in your investment vocabulary or
Oh yeah. Like I'm totally for cloning. Like I think cloning is a great idea if as long as you make sure that whatever company you're buying, you believe it's within your circle of competence enough and you've done your own homework to like defend it. Like it's not enough to just clone and say, "Oh, I bought airlines because Buffett bought airlines." Like that's not enough of a reason to clone Buffett. It would be more like, yeah, I've studied Delta and United and Southwest. And according to all these metrics, Southwest is the best. And I like their service. I'm a customer of Southwest and I like the CEO. I think he's got integrity and talent. And, I read their annual letters and I've done all this homework to know what risks I'm getting into. Like, then sure, then go clone if that's what you really believe in and you think that there's a bright future for Southwest. And of course, that's just totally a hypothetical example, but that's where I think cloning is right. And I think that's how Monish Pabrai intends cloning to be. It's not just blindly copying someone and like crossing your fingers hoping that it works out.
right? Yeah, he's mentioned. I mean, he's the cloning man, but he's mentioned recently. Um, I go to other investors for idea generation, and at that point, my cloning brain turns off and my analytical brain turns on once I see an idea. So that's kind of what I think is probably the best approach for me personally. Um, kind of echoing exactly what you said. It's really important, I think, to understand the business because you can clone an idea, but you can't clone conviction, I guess is the common saying.
Oh
So,
yeah, that's a
uh,
great saying.
and even I'm pretty sure in Berkshire Hathaway annual meetings, Warren and Charlie have both said um, using other intelligent investors for for investment ideas is completely fair game. It's a good idea, actually. So, I mean, not that I need their permission to do anything, but um, I think it's foolish to ignore what others are doing. There's no points for originality. So,
Yeah, and if you are, I mean, I don't know if anyone tries to go out of their way to be original, but like I'm not aware who is. If you know who those people are, we could probably talk about them to not like, out their laundry or something. But like I think a lot of times if someone is like kind of investing on their own, they might be specialized, like they're really into micro caps and they just know and understand and feel like that's within their wheelhouse. So if they're if they're kind of doing that micro cap thing, and of course, the big investors aren't going to play around in micro cap because it's not enough to move the needle, as Monish says. So, but like, I'm not personally aware of anyone who's just, kind of putting out their own little investments and saying, oh, these are the best companies, and everybody should follow me. Like, I mean, there's very like rare that I feel like I've seen someone try to like toot their own horn, but not usually. And I agree with you that it's a great idea. Like I usually look at when the new 13F filings come out and like I enjoy like seeing what has changed and analyzing why something might have changed in the portfolio. And like I know Berkshire Hathaway had bought some, I want to say Chevron, and maybe it's because oil has been kind of going up and maybe, getting if they bought it at like $100 a share, maybe getting $5 of dividends is not a bad gig when treasury rates have been almost nothing. So maybe, for the time being, they're just parking some cash with that stock, not necessarily because they love it as a stock, but maybe just to get some cash yield, I guess. So, I mean, that's just conjecture, but it's what I'd like to try to wonder about.
Yeah, I mean, it's a whole different ballgame for large funds, even the funds on 13Fs, compared to say what my personal fund is. It's a huge difference. Um, it was interesting you mentioned the microcap space and relating that to kind of uh, trying to be original versus not. And while I agree, people don't intentionally try to be original with their investment ideas in the microcap space in particular. I think it's really hard to actually copy people because there's not a lot of coverage or information out there. There are a few resources like Microcap Club, I think, things like that, where people share ideas about specifically microcaps. But that's a space where if you're not an independent thinker, I think you could potentially get really hurt. Um, so that's something that I've dipped my toes into, but it's not a core part of my investment strategy yet. But I do think that that's a very interesting way to challenge your own intellectual capabilities and your own investment capabilities.
Yeah, like in a way, maybe it could be like how Buffett went about his investing process in the beginning, where he was scuttlebutting around and trying to learn about companies and talking to their managements. So it could be, potentially a cool way to go if, you kind of get in on the ground floor of like a newer business in a way that it's in its earlier stages, and if it resonates with your values and you believe in that company, then it could be I could see why it's a pretty attractive and lucrative space sometimes, because it could be like finding, gems, like hidden gems that you could have the potential of growing more someday. As like I'm assuming a lot of companies start out being pretty small, so I'm guessing that it could be a nice fertile ground if, like you said, you want to use your intellectual power to figure out, what is a true good investment. But I think it's still a little tricky for me because, like you said, there's not as much financial data available for those. So it's kind of like even that space is a little bit outside of my circle of competence, and I would need to try harder because I don't know if they have 10Ks readily available or whatever they release. Like I'm not even sure what are the main documents that they tend to put out, and if they're able to capture the breadth of information that a lot of other more common companies have information out about them. So it's sort of like, I don't know, like I'm comfortable with like focusing more on the larger or mid cap stocks, like, or even some small caps, but like I try not to go below small caps for now.
Mhm. I'm typically there with you, but I actually am looking at a microcap situation right now. It's a special situation. It's not really a long-term investment, but uh, I've always been trying to think, how can I incorporate some more of these potential very asymmetric bets in special situations into the portfolio? And the main hesitation I have is simply the fact that it requires a lot more attention. Say I buy shares in Apple, I don't have to look at those until I die, or I never have to look at those probably. So
Mhm.
it's a very different game, but it's still fun. It's like digging for gold. Like, and occasionally you find something, but as you said, most of these companies, a lot of these over the counters companies don't have any public filings, so you actually would need to go to the company, probably look at their books physically, and you know, I'm not a full-time investor. That's probably not in the cards for me at this moment. So, yeah.
Yeah. Well, and even looking at, I felt very intrigued by how both Monish and Guy Spear bought into Prosus. And then there's like at least three different versions of Prosus that someone might be able to buy, like
Mhm.
PRX in the Euro exchange, and then also ProC and ProCef in the States, maybe sort of as OTC. Like all of this is just super confusing, and like people have not yet released information to fully clarify, like why even is there a PROSF compared to PROSY. And then there's also like a lot of info just lacking on these things. And like, I think that some sites like Dataroma try to source information, but I don't even know how they source their information too. So like, I don't know if some of the funds that they cited as owning ProSef, if they truly own ProSef or if they actually own PRX, but only PROSF is the version that you see in the States. So like, I don't know. Like, so some of this is still like a big question mark to me. I'm like trying to figure, it's like trying to do like investigative work and trying to just dig up
Right.
what you would think should be more publicly obvious, but it's not.
Right. And I'll offer some clarity on the specific process situation. Um, anything that's listed on Dataroma is sourced directly from the SEC filings. So anything there is purchased through some sort of exchange or over the counter in the case of process. Um, there are some services like Ticker that actually somehow are able to go through trade reports. It might be available through whatever data API they use for their information, but they do source international holdings. So anything on Dataroma, just rest assured that that's US based for now. So
because it like one of them I remember seeing, like I pulled up some shareholder report from the actual fund itself and it said like PRX, and that was different than what Dataroma had as PROSF. So I'm like, I found a discrepancy because the actual report from the actual fund is saying PRX. So it's, that's a little bit of a, I don't know, like, it's good to like get some information, but I always try to like verify it further and try
right,
to like find the source documents, like the actual 13F, to see if I can validate what I'm seeing on either like, Dataroma, Ticker, or Whale Wisdom. Like some of these like don't always have the most correct, like they're generally correct, but it's not always like 100%, or just like how, obviously with Monish and Guy Spear, whatever we see on Dataroma is not actually their full portfolio.
right, yeah.
Yeah, it's all
That's
that.
that's always a tricky thing to follow because yeah, if you look at Dataroma, Monish Pabrai has 3 portfolio positions, but if you pull back based on just what's available on Ticker and then based on what he talks about in his talks, he definitely holds his favorite stock is not on either of those websites. Or oh no, Racesus is actually on Ticker, but that's the one that he's been talking about a
Wait,
lot.
which
And
one?
Racesus, which is a logistics and warehouse operator in Turkey.
Oh, so he said that's his favorite company?
Yeah, I
Oh,
mean it's his. He thinks it's going to be a massive performer in his portfolio, and it's the only one he seems to be talking about besides Tencent. So
oh, interesting. I haven't come across that yet. So,
hey, you got to check out some of his interviews from a few months back. He goes at length about the business, which the business sounds amazing. I think people, well, first of all, it's difficult to actually invest in Turkey, but I think people would find that hard to stomach as well. But,
yeah, I mean, the geopolitical tension
right,
stuff, generally what's happening, like it's always like there's always controversy, and also there's the actual like, how do you invest? Like I've also heard Monish rave about India Energy Exchange or India Gas Exchange and some of the other Indian companies he invested there. But then how do Westerners invest in some of those companies? Not that I'm saying, I'm not necessarily trying to invest in India Energy Exchange, but what if I was? Like, how would I even, I guess I could call Interactive Brokers and say like, hey, I'd like to open a new brokerage account. What's the easiest way for me to buy into that company? But like, I mean, that's just like, I guess perhaps some future investing, if things continue to stay kind of overpriced in the US, is what I feel like it is. Like this might force investors to have to find companies elsewhere, like in international places that, I don't know, like how how easy that will or will not become, because it's like, just when we feel like we don't have enough information on US listed companies, like what about companies that are listed on other exchanges? Like how do you even begin to find information on those too? So it's feel like,
exactly.
Yeah, it's like a little bit of a difficult thing. So I don't know how, like, I'm curious to figure out how someone like Monish or Guy Spear, how do they get to learn about some of these foreign companies that they then like, and how would they invest in whatever exchanges? Like, do they have special rights to do that because of having like certain licenses, or who knows? Like, I have like no idea how they're even able to invest in exchanges all over the world.
Right. That's a situation where it feels like having connections and actually having an established fund structure is really helpful for them. Um, I know that Pabrai he basically has a friend in Turkey who I'm sure was able to walk him through everything that he needed to know about setting up investments. But you and I at this time don't have resources like that. So um, it'd be nice to see that more democratized for individual retail investors. Interactive Brokers does a pretty decent job, I think, about offering a large swath of international positions, but I don't know. Yeah, I don't know if you can invest in India off the top of my head or Turkey or anything. Um,
Yeah, yeah, I'm curious about that too. And I mean, it's amazing how, like, speaking of democratizing that type of access, like, I think you and I are really into investing in general, that we would even be curious about topics like these. But like these kinds of topics that we're talking about are like further along than what I think a lot of the population overwhelmingly still struggles with. Like, a lot of people don't even know where to start with investing or how to even think about investing. And like, I'm just grateful that I feel like at least I've landed on an approach that I'm comfortable with and that I'm able to move forward to. But if someone's like, do I put my money in a certain fund, or which fund, or like a target date fund? Like, if someone's just there, I mean, they're, that's one place that I think a lot of Americans are at. But then imagine where a lot of people internationally are at. Like if you're someone in Africa or Latin America, how do those people invest? Like, it's like, there's so much more financial services that so much more of the world needs, that it's still, I don't know, there, I guess it just feels like there's so much more to do. And like, not that I'm part of any fintech kinds of things, but like, I'm hoping that fintech companies also bring more financial services and empowerment to all international populations, so that they can also invest in companies too, like, if not only in their own country but also in maybe the States or in Asia or wherever they want to invest.
right. I think that's really important. Investing education and personal finance education is extremely important. Not that even people need to necessarily invest in individual stocks. I mean, I'm not saying I'm going to be good enough to invest in individual stocks for the long term, but just understanding the different options that you have out there is the first step. So let's switch gears real quick to kind of what your view is on where the market is right now and how you're navigating the what some might call turmoil.
Well, some of it, I believe it's in the early innings, to borrow from baseball. And like, I'm just waiting for whenever my fat pitch comes along, because I've prepared a wish list of companies, of stocks that I'd like to buy if they reach a certain price. And then that's basically what I'm going with, which is different than, some people say you can't time the market, but by having a wish list of companies, stocks, and having a price tag that I'd be willing to pay for their stocks at, that's not timing the market. That's just knowing what deal I want to pay for. Like, it's the same thing. Like, a certain TV costs a certain amount during most of the year, but during Black Friday, that it goes on sale 50%. So if if you don't need to buy that TV right away and you'd rather buy it when you're getting a pretty good deal, that's what I like to think of as trying to have a wish list of companies, stocks that I like to buy at a certain price. And right now, a lot of the share prices are not at the amount that I'd like to pay for them. So I'd rather not pay full retail price for a lot of companies. And this goes along with how Warren Buffett doesn't believe in efficient market hypothesis. So I don't either. Like, I don't equate that price is equal to value. So if those two things are not always the same, then I think there's opportunity to buy something at a discount to its intrinsic value. And then that's what I'm looking forward to. So I'm not necessarily, looking forward to having economic turmoil, but it just feels like, it's sort of been too much of a party. Like we've had this bull market party raging kind of nonstop. Like I know we had that 2020 crash, but that's kind of like 1987. And I feel like a 1999 could be coming upon us where like the actual recession is still lurking out there. And it's like a lot of people will probably be, you know, unpleasantly surprised when it might hit them and their portfolios. But it just feels like we've been at all-time highs based on a lot of metrics like Schiller PE and Buffett indicator of Wilshire to GDP. And it just feels like, I don't know, like I'd rather try to be responsible and know when to leave the party. Like if it's already like 4 a.m., like it's time to go home and not just keep dragging on what I feel like is an inevitable end to the party. So I'm sort of looking forward to hopefully having an opportunity to buying stocks on sale.
Yeah, and I think I love the idea of uh, this preparedness with a watch list with prices of intrinsic values that you think might be reasonable for these companies. I'm curious how much of a pulse you have on all those companies on the watch list, or if it's you know enough about the company where you might make a reasonable judgment about the price, and then if you see the price drop, then you dive deeper, or you will be ready to invest at that time. How do you kind of run that watch list?
Well, I mean, I generally know what some of the stock prices are. Just I periodically check on them like every week or 2 weeks. And like in general, like if the overall market is still where it's at, you know, it's only gone down, you know, maybe 10%. Like to me, that's like not enough of a discount because it's not brought down enough of the companies that I would like to buy nearly enough. So they might be, you know, maybe they're down like 10, 20%, but that's not, I don't know, that to me, it's like the tip of the iceberg of what could potentially be coming, especially if people like Jeremy Grantham are correct. Like he predicted that the S&P 500 could go down to 2,500 and maybe you could even overshoot that. So if that's a 50% drop from where it was more or less, like that would ultimately bring down a bunch of other large cap companies, some of which I'm also interested in buying. So just trying to like see things by proxy in parallel. Like if generally the market's only gone down 10%, like to me that's like not nearly enough of a discount. It's like okay, but like doesn't excite me to want to buy my company. So I'm not sure if I answered your question the way you're like if I was aligned with what your question is, or let me know if like I didn't answer quite like what you were expecting.
That's some useful insight. Um, I was just curious how much research you do before putting a company onto the watch list also, in addition to what you spoke about. Is the watch list, because for me, my watch list is companies that maybe I've read a write-up or something on, but I don't necessarily think I would be ready to pounce on the opportunity if it hits my strike price, for instance. Um, so yeah, I
So,
don't know if that's
so one of my like I've had like a wish list in general, and then I hadn't updated my research like during the 2020 crash, I was a little bit off guard because I hadn't quite done enough research on some things. Like I was a little bit behind on maybe some positions, and then when everything was going down, part of me was like, maybe I want to act. So I bought a little bit, but like part of me was also like, some of it's not on sale enough at like even 35% down. So I was like, part of me was like, I don't want to buy because it hasn't met my margin of safety criteria yet. And
Mhm.
so some of the companies I felt more comfortable with being, you know, sticking closer to my range of margin of safety. I was like, you know, maybe I was being stubborn. So maybe that's my own like error of omission in that I sat out, even though I could have bought something on sale for 35% off. Maybe it's a little bit of hubris to me to believe it's not on sale enough. And so I'm not going to pull the trigger and buy yet until it actually goes to what I think the price should be. So, you know, arguably I could have missed out on some of the gains over the last couple of years as some of these stocks just went up, but then everything else went up. And then I'm like, well, you know, who knows if I will consider this a mistake in the long run, or if maybe it's better because if you buy in, you tend to, I mean, this, I'm not talking about you, but like just in general, speaking for myself,
Mm.
I would feel attached if I bought into something. So if it like runs up, I don't know necessarily when to quit while I'm ahead. So I might be hesitant to sell something if it's trading at maybe its all-time high. And then like, who knows if it reaches another all-time high some
Right.
time from now. So I wouldn't know maybe where to, you know, take some gains off the table. But then if it started going down, then I might start doubting myself. But if I had never invested at a price that I didn't think was good enough, then I don't really have, I don't like, I won't second guess myself because I'm not in that position to second guess if I paid too much or not. So yeah, I don't know if that helps a little bit,
Yeah.
but a little bit
Yeah.
how I'm thinking about it.
Monish Pabrai has this saying that he wants to be extremely unreasonable about the things that he buys. And I think a part of that is paying the right price, because buying an overpriced asset can lead to 0% or negative returns very easily, even if the asset is wonderful. So, I mean,
Yeah, like
I think
like you said,
having a prepared mind is, sorry, yeah, having a prepared mind is a wonderful tact. But please go ahead. Sorry.
exactly to your point. Like I remember him saying in one of his webinars, like you don't want to buy a company at only 80% off, 80% of its intrinsic value. So only a 20% discount. Like because it's not going to grow necessarily as much to its full intrinsic value. So it's like, I remember someone commenting on my YouTube video, like, this was just some person. I don't know what they're judging it on, but he was like, oh, Berkshire Hathaway's trading at 20% discount to its intrinsic value. And I'm like, maybe it is, but like, so if that were true, is that a good enough discount to me? So that's what I think. I'm like, okay, it's cool if that's good enough of a discount for that person, but I kind of just was like, I'll just kind of chill and not, keep sitting on this, even though I would love to buy more Berkshire Hathaway personally, but like, I'm gonna try to buy it when I think it's actually on sale and not necessarily, at some smaller amount that maybe to Buffett it's on sale and that's why he's been buying back stock. But to me, I'm like, I'd rather wait until the whole market brings it down because, when people sell massively out of index funds, it doesn't just bring down a few, it brings down all of the, blue chip, big market cap stocks. So I'm like, at some point, Berkshire Hathaway is bound to go on sale eventually again. So I'm like, not even in a rush to want to buy it. So in a way, like it helps me buy time that even though I'm comfortable enough with the stocks on my wish list at a certain price, but like I have more time to keep studying them. So it's like until they just get to that range of when it's time to buy, then I start buying, and it's almost a little bit anticlimactic because as soon as you secure some of the shares, now I'm like, okay, now it's just time to wait like for a decade.
Right.
So it's like I don't know, like it's um you feel like you work so hard trying to build out your circle of competence and study all these factors, and then by the time you actually make the decision to buy, then it's almost like, okay, a weight is lifted and I can just hang out.
Right. That's maybe one of the best feelings just after having made an investment. Although it seems that my investments always go down after having made one. But I love that idea of being unreasonable and just waiting for that obvious moment where it's basically screaming at you that now is a good time to buy. And I also loved your point about how each individual's expectations for investments is different. So somebody might think that a 10% discount to intrinsic value is an appropriate investment. Others might think that I need at least a double in my intrinsic value in order to put money down. And that's just one of the great things about being able to discuss with other people and learning their ideas. But you also have to take into context how they operate, what their compass is within investing. So everybody says that they're long-term investors, but it's really something that needs to be discussed. What does long-term mean to you? What does value mean to you? All of these are relative terms for everybody. So
Oh yeah. Well, and I know um, based on just that alone. Like value means so much to different people. Like I mentioned earlier when we were first talking, there's like mainstream value that like there's certain metrics. Like I tried looking into this once of like you could buy like a growth ETF and like a value ETF, and they have certain measures that they base value on. And so people tend to associate that with like Warren Buffett of like, oh, value, because it's, not growing as fast, and it's like kind of slow but steady kind of thing. But then even though people think of Buffett as sort of that kind of value, and then there's also the Ben Graham kind of value, but then there's also the value that's like Charlie Munger value. So like I've actually come to realize that Charlie Munger's approach is actually somewhat different than Ben Graham's approach. Like Ben Graham was more cigar butt, and Charlie Munger's more wonderful company at a fair price, not dirt cheap. Like you pay a reasonable price of what seems fair to you. So I've learned also from like another study that Buffett is actually more of a large cap growth investor rather than what everybody calls him as a value investor. So it's sort of ironic that like I this is why I try not to call myself a value investor or growth investor, but I just settle for like a Warren Buffett style investor, because Warren Buffett can mean different things to different people, but he means something in a certain way to me, and it's more closely aligned with Charlie Munger. So I like to think of that rather than if someone just automatically goes to, oh, you only buy low PE companies, because I don't only buy low PE companies. Like that's not, I think Monish Pabrai is also getting away from that, where he used to buy just low PE companies like Fiat Chrysler, but he's also trying to evolve his thinking and not just only be about the low PE companies.
Yeah, absolutely. That's ironic that if you're using the value and growth terms uh, in terms of the mainstream sort of definitions, that Buffett falls under that growth category. Because he
Yeah.
absolutely does, because growth is a huge part of value, especially in his investable universe. It's the value has to come from somewhere, and more often than not, the companies that he can invest in are dollars growing into $1.50, as opposed to 50 cents growing into $1, reverting back to the mean. So yeah, my preference is if Warren Buffett is a growth investor, then I'll take it. I'll join him in that camp.
Yeah. I mean, whatever it is, like I guess like the moral of the story is we don't have to necessarily pick and choose any particular label. Like I
Absolutely.
think it's I think it's actually better to be a little bit more fluid, and I think that Warren Buffett also tries to, just keep learning and be open-minded to change, because I think that's how we truly become the best investors like Charlie and Buffett did, is by always being willing to change and learn something new. Because if we don't, then we might be rooted in certain dogma and ideology that eventually might hold us back. And i think and i think we see that transformation happening in someone like Monish and also Guy. Like they're also in the middle of their own kinds of investing transformation. Even though they've been doing investing for like 25-30 years, they they're also constantly changing, I guess, like as is evidenced by some of the moves we've seen lately. So yeah, I think it's always exciting, and that's what makes me feel, maybe to end on this, like what I love so much about investing is um it makes me feel self-actualized. Like it's the truest version of myself that I'd like to be, and that it, like trying to be the best investor I can be makes me want to achieve my fullest potential. And I think that that's one of the avenues that I can realize that full potential maybe. So like I'm just happy to try to just be along this journey and keep learning. And like what is it about investing for you? Like what do you feel like you get out of it the most?
Um, it allows me to satisfy my intellectual curiosity while at the same time striving for financial independence for me and my family. Um, there's a lot of things I want to do in this life, and um, I found something that is both rewarding intellectually and hopefully financially. So um, we'll see where that takes me. But yeah, the the number one driving factor for me is that I get to read all sorts of things. Every single thing I do falls under the umbrella of investing. Um, And I just love that I have something to hang my hat on, and it gives me, not to use a cliche, it gives me that lattice work, or just a bunch of hooks hanging from my brain that, okay, this fits into my investing thesis this way, or it doesn't. Maybe I'll just hang it there for later. So it's just a whole lot of fun to do that, I think.
Yeah, I agree. Same here. I also want to achieve financial independence and help out my family too. So that's awesome. I'm so happy that we got to talk, CJ, and like I feel like we're kindred spirits with how we invest and want to be on the lookout. So I'm super grateful to have come across your channel, and I love watching your videos and greatly appreciate your feedback, and hope we can continue growing in the investing community that's on YouTube and elsewhere. And you know, like I just think it's so awesome to be part of this time where I think we only have upside. Like I think if we keep trying to do our best to learn and keep being curious, I think we can't help but eventually be successful. Maybe we already are successful. So I think that's just awesome. So thanks, CJ.
Yeah, thank you, Michelle. All the same to you. Best of luck with your channel. I'm sure we'll connect again soon. This has been a lot of fun.
Same here.
Thanks a lot for connecting.
All right. Bye.
I hope you enjoyed my conversation with Michelle. If you haven't already, please subscribe to Michelle's channel. She puts out a lot of wonderful and insightful investing videos. So if you want to become wiser every day, then I would suggest giving Michelle a follow. I had a lot of fun recording this. I know this is a little bit of a different style of investment video, and let me know in the comments below if you enjoyed this long form type of format video, and maybe I can incorporate that more regularly onto this channel. In the meantime, if you enjoyed this video, you may enjoy this video over here. Otherwise, please like the video and subscribe to the channel for more. I thank you so much for watching this all the way to the end. I really appreciate your time, and I will see you in the next video.